The Alchemy of Finance by George Soros. Picture this, September 1992, London's financial district. You can practically taste the tension in the air. A battle is brewing between the Bank of England, this centuries-old institution representing British economic power, and one quiet Hungarian immigrant turned billionaire investor, George Soros. For months, Soros had been studying the UK economy like a detective examining clues. He noticed something that politicians and central bankers either missed or refused to acknowledge. The British pound was stuck in a European exchange rate system at an artificially high value, slowly strangling the economy and deepening the recession. Meanwhile, the government kept putting on a brave face, insisting the pound's value was a matter of national pride. But here's the thing about markets. They don't care about pride. They care about reality. And Soros knew the pound was barely hanging on, so he made a bet. Not just any bet. He risked everything. He borrowed billions of pounds and immediately sold them for other currencies, like the German Deutsche Mark, betting the pound would eventually collapse. The Bank of England pushed back hard, buying up every pound being sold and raising interest rates to make betting against them painful. The entire financial world held its breath. Could one man really take down an entire country's currency? Then came what history would remember as Black Wednesday. After spending billions trying to hold the line, the Bank of England simply couldn't keep up with the selling pressure. In a stunning admission of defeat, the government announced it would pull the pound from the European system. The pound crashed. George Soros? He walked away with over $1 billion in a single day, forever known as the man who broke the Bank of England. But this story isn't really about making money. It's proof of a radical idea Soros had been developing his entire life, an idea so powerful it let him see what others couldn't. An idea that explains not just market booms and busts, but the rise and fall of nations and the very engine of human history. That idea lives at the heart of his legendary book, The Alchemy of Finance, and I'm about to share it with you. By the end, you'll understand the secret that let George Soros read the market's mind. A secret that has nothing to do with complicated charts or financial jargon, and everything to do with a fundamental truth about human nature. This isn't just a book about finance. It's about how our beliefs, biases, and flawed perceptions don't simply reflect the world, they actively shape it. To understand how Soros thinks, we need to rewind to his student days. Imagine a sharp, curious young man sitting in economics class, learning the standard theories about efficient markets and how prices perfectly reflect all available information, like a thermometer reading temperature. The theory was elegant and beautiful, but something felt off to him. When he looked at the real world, he saw manias, panics, bubbles, and crashes. People weren't the perfectly rational robots the textbooks described. They were driven by fear, greed, hope, and herd instinct. The market wasn't a perfect mirror of reality. It was more like a funhouse mirror, distorting everything it reflected. This became his lifelong obsession. The textbooks claimed that reality, the fundamentals like a company's earnings or a country's economic health, determines market prices. But Soros sensed something was missing. He realized the relationship wasn't a one-way street. It was a two-way feedback loop. This is the book's core idea, and he called it reflexivity. Think of it this way. The traditional view is simple cause and effect. A company has good earnings, so its stock price goes up. Done. But Soros said no, that's not how it works when thinking people are involved. The chain goes from fact to perception, and from perception back to fact. Here's a simple example. Imagine a young actor who gets lucky and lands a role in a hit movie. People start saying, this actor is the next big star. That's the perception. Now, because everyone believes he's a star, he gets offered better roles. He becomes more confident. He works with better directors who help him improve. His belief in himself, and the world's belief in him, actually makes him a better actor. The perception has changed the reality. The star is born not just from talent, but from the belief in that talent. That's reflexivity, a two-way feedback loop between what we believe about reality and what reality actually becomes. Soros breaks this into two functions. First is the cognitive function, our attempt to understand the world. It's passive, where we observe and form beliefs. Reality shapes our perceptions. Second is the participating function, our attempt to change the world based on our beliefs. This is active. Our decisions, based on our perceptions, create impact. In natural sciences, these are separate. A scientist observing a planet doesn't change its orbit by looking at it. But in human affairs, economics, politics, markets, these two functions happen simultaneously and interfere with each other. Our understanding is always flawed, always incomplete. Soros calls this the participant's bias. We never deal with pure objective reality, only our interpretation of it. And here's the magic. Our biased interpretations then actively shape the reality we're trying to understand. This is where Soros broke from every economic theory of his time. He said this feedback loop doesn't lead to stable balance, or what economists call equilibrium. Instead, it creates a dynamic, never-ending process of change. Sometimes the loop is small and self-correcting, but other times it creates massive, self-reinforcing movements that push things far from equilibrium. And this is the secret to understanding the most common pattern in financial history, the boom and bust cycle. For Soros, a boom-bust cycle isn't random. It has a predictable structure driven by reflexivity. It starts with two ingredients, an underlying trend in reality and a prevailing bias or misconception about that trend. Here's how a typical cycle unfolds. It begins with an unrecognized trend. Something real is happening. A new technology emerges, a company genuinely improves, but the market hasn't noticed yet. As the trend develops, the market starts catching on. This kicks off the self-reinforcing process. As people recognize the trend, they start buying, pushing prices up. Here's where reflexivity takes over. The rising price isn't just reflecting good news. It starts improving the underlying reality. Soros gives a perfect example from his career. The conglomerate boom of the late 1960s. Investors loved companies showing consistent earnings per share growth. They didn't really care how that growth happened. Some clever companies figured out they could manufacture this growth. Say a company's stock trades at 20 times its earnings because investors think it's a growth company. It uses that expensive stock to buy a boring traditional company trading at only 10 times earnings. When they merge, the combined earnings per share magically jump. Investors see this jump and think, wow, look at that growth. They bid the stock even higher. This higher price lets the company buy even bigger companies, creating even more growth. The perception that this is a high-growth company fuels a reality that seems to confirm the perception. The trend reinforces the bias, and the bias accelerates the trend. As this continues, it often survives a successful test. The market might dip a bit, a moment of doubt, but if the reflexive process is strong enough, the trend comes roaring back. Surviving this test strengthens conviction. Doubters are silenced, and everyone jumps aboard. This leads to growing conviction. The gap between perception and reality widens dramatically. The bias becomes exaggerated. Expectations detach from any plausible reality. This is when you see shoeshine boys giving stock tips, when it feels like prices can only go up forever. But inside every reflexive boom lurks a hidden flaw in the perception. In the conglomerate boom, the flaw was that this growth was an accounting trick, not real sustainable progress. Eventually, the company runs out of smaller firms to buy, or the acquisitions become too big to digest. This leads to the climax, the turning point. Reality can no longer sustain exaggerated expectations. Maybe a company reports earnings that are merely good when the market expected miraculous. That's all it takes. The moment of truth arrives. The flaw in the prevailing bias is exposed. Suddenly, investors realize the story they believed isn't true. This triggers a reversal. And just as the process was self-reinforcing on the way up, it becomes self-reinforcing on the way down. People start selling. Falling stock prices make it impossible for conglomerates to make acquisitions. Their growth engine dies. Accounting problems swept under the rug during good times are exposed. Bad news leads to more selling, which creates more bad news. The process feeds on itself until pessimism becomes as exaggerated as optimism once was. This is the bust. Eventually, prices fall so low they become bargains, and the cycle finds a bottom, ready to start somewhere else. This boom-bust model was Soros's map for navigating markets. While everyone else looked at fundamental value, Soros looked for the reflexive feedback loop. He searched for the misconception, the prevailing bias driving a self-reinforcing process. Once you spot that, you've found the potential for a truly historic market move. He applied this same logic to the real estate investment trust boom of the early 1970s. He saw that these companies could grow by selling new shares at a premium to their book value. The higher the premium investors paid, the faster the company could grow earnings, which justified an even higher premium. Another perfect reflexive circle. He invested heavily and made a fortune on the way up, wrote a detailed analysis predicting it would all end in a bust, and when that time came, made another fortune betting against the very companies he once championed. This thinking wasn't limited to stocks. Soros saw that reflexivity was even more powerful and continuous in currency markets. Classic theory says if a country's currency becomes overvalued, its exports get more expensive, imports get cheaper, and the trade balance shifts, automatically correcting the currency's value. A nice, neat, self-correcting system. Soros said this was nonsense. Experience since 1973, when exchange rates started floating freely, showed the opposite. Instead of fundamentals determining exchange rates were determining the fundamentals. He described this in terms of vicious and benign circles. For example, a strong currency fights inflation by making imported goods cheaper. For a country like Germany in the 1970s, which imported many components for its exports, a strong Deutsche Mark didn't necessarily make products uncompetitive. This created a benign circle. The strong currency kept inflation low, which kept the economy competitive, which supported the strong currency. The process was self-reinforcing. Soros saw this play out massively with what he called Reagan's imperial circle in the early 1980s. The United States had high interest rates, a strong economy, and a strong dollar. High interest rates attracted capital from around the world, pushing the dollar even higher. The strong dollar acted like a pressure valve for the economy, allowing the U.S. to run huge budget deficits without causing massive inflation, because cheap imports kept prices down. So you had a reflexive loop, a strong economy and high interest rates led to a strong dollar, and the strong dollar allowed the policies keeping the economy strong to continue. It was a beautiful, benign circle for America, but it was vicious for the rest of the world, especially developing countries whose dollar-denominated debts now had to be paid back with a constantly rising currency. Soros understood this too was a boom-bust process, fundamentally unstable. The growing U.S. trade deficit meant the country was becoming increasingly dependent on foreign capital. The trend was bound to reverse. The only questions were when and how. This leads to one of the book's most remarkable parts. In August 1985, as he was writing The Alchemy of Finance, Soros decided to conduct a real-time experiment. He kept a diary, recording his investment decisions and reasoning as he tried to navigate the end of the imperial circle. He was publishing his playbook while running the plays. He started believing the imperial circle was unsustainable. A strong dollar was crippling American industry, and at some point the whole process would reverse. He predicted a weaker dollar and weaker economy would reinforce each other. The experiment was, in his words, a roaring success in financial terms. His fund had one of its best periods ever. But what's fascinating is how his views evolved. The situation didn't play out exactly as predicted. He thought the system would crash under its own weight, but he underestimated the role of authorities. In September 1985, the finance ministers of the 5 largest economies, the G5, met at New York's Plaza Hotel. They agreed to intervene in markets to bring the dollar down. It was monumental. The era of a freely floating dollar was over. Governments were now actively managing the system. Soros recognized this as historic. He realized the rules had changed. The system wasn't going to crash. It was going to be managed. This insight let him ride the falling dollar trend with tremendous conviction. The experiment revealed the true nature of his alchemy. It wasn't about having a crystal ball. His initial prediction of inevitable crash was wrong. His success came from using his reflexive framework to understand events as they unfolded, recognizing when his hypothesis was flawed, and adapting to new reality. He saw the Plaza Accord not as random, but as part of the larger reflexive dance between markets and regulators. He understood that regulators themselves are participants with their own biases and imperfect understanding, and their actions create new feedback loops. This is the profound lesson of the alchemy of finance. Soros wasn't just a trader, he was a philosopher in action. He saw the world not as a machine governed by timeless laws, but as a historical process, open-ended and uncertain, driven by the flawed, biased, and wonderfully human act of thinking. He believed the participant's bias is key to understanding all of history, just as genetic mutation is key to biological evolution. He argues that great ideas shaping history are often fertile fallacies, misconceptions powerful enough to change the world until their flaws are revealed and a new fallacy takes their place. Each provides new experience, and as long as we learn from that experience, the process can be called progress. Ultimately, Soros's theory is a radical critique of our quest for scientific certainty in human affairs. He argues social science is a false metaphor. We've tried applying natural science methods to a fundamentally different subject. In human events, the observer is also a participant. The theories we create don't just describe reality, they can change it. Marxism, Freudian psychoanalysis, even the theory of perfect competition. These weren't just descriptions, they were powerful ideologies that shaped the world, often in ways their creators never intended. So Soros concludes that in the world of human affairs, we're not scientists discovering timeless truths. We're alchemists. We're participants in a grand reflexive experiment, trying to make sense of a reality we're simultaneously creating. His success came not from finding the right answers, but from embracing uncertainty, understanding the power of our own imperfect beliefs, and learning to dance with the feedback loops that shape our world. So what do we take away from all this? It's easy to get lost in financial theories, but the alchemy of finance offers something much deeper and more personal. At its heart, this book is a profound meditation on uncertainty and human fallibility. We live in a world that craves certainty. We want formulas, rules, and predictable outcomes. We want to believe that if we just gather enough data, we can know the future. Soros's entire life work shows that in any system with thinking people, this is an illusion. The most powerful lesson is reflexivity itself. Once you understand it, you start seeing it everywhere. You see it in social media trends, where a video goes viral simply because people see it's going viral, creating a self-reinforcing loop of attention. You see it in politics, where a candidate perceived as a frontrunner gets more media coverage and donations, which solidifies their frontrunner status. You see it in your own life, in the power of self-confidence. If you believe you can succeed, you act in ways that make success more likely, which strengthens your belief. This book teaches us to be critical thinkers, to always look for the prevailing bias. When everyone is certain about something, that a stock can only go up, that a housing market will never fall, that a certain political outcome is inevitable, that's the moment to be most skeptical. That's when to ask, what's the misconception here? What's the flaw in this belief system that, if exposed, could cause the whole trend to reverse? So how can you apply this powerful idea right now? First, practice intellectual humility. The core of Soros's philosophy is accepting that our understanding is inherently imperfect. This isn't weakness, it's the starting point for true wisdom. Be open to being wrong. The most successful people aren't those who are never wrong, but those who recognize and correct their mistakes quickest. The market and life gives us feedback. Listen to it. Second, learn to identify feedback loops. Look for them in your studies, relationships, and habits. Is there a small action you could take that would start a positive, self-reinforcing cycle. Maybe it's exercising for just 10 minutes a day. The act itself is small, but it creates a feeling of accomplishment, giving you more energy, making you more likely to exercise again tomorrow. You're actively changing your own reality through a reflexive loop. Finally, think in terms of history, not just science. The future isn't a destination that can be calculated. It's a path being created moment by the choices of billions of flawed, biased, and creative human beings. Instead of trying to predict the future with certainty, think about forces at play, prevailing biases, and potential for them to be challenged. This will make you a more flexible, resilient, and ultimately wiser participant in the grand unfolding of events. That was a look at The Alchemy of Finance by George Soros. We've journeyed through some deep and powerful ideas today, but honestly, a summary can only ever be a map. The real treasure is found when you walk the path yourself. The true magic of this book is in how Soros thinks, how he connects huge, world-changing events to a simple underlying principle. This summary is your invitation to explore that mind. If anything we've talked about has sparked your curiosity, if you feel that pull to understand the world on a deeper level, I truly encourage you to pick up a copy. Reading it isn't just about learning a financial theory. It's an experience that can fundamentally change how you see the intricate dance between belief and reality. A link to the book is in the description. Also, if this journey into the mind of a master investor was valuable to you, please show your support by hitting that like button and subscribing to the channel. That way, you won't miss our next exploration of another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.